Want more money? Who doesn't, right? Though that may not actually be what you really want. What we really crave is financial freedom, to enjoy a lifestyle free from money worries and that funds our needs and wants. In this video, Sam Dogen, famous online as the Financial Samurai, shares the steps that anybody watching this video can take to achieve financial independence.
Because once you get a really nice sizable capital base, the number one rule in my mind of financial independence is to not lose money, to not go backwards. So once you've tasted that sweet nectar of freedom, you don't want to go backwards and be someone's employee or have to do something for money again.
Hello and welcome to Peak Prosperity. I'm Adam Taggart, co-founder of peakprosperity.com, welcoming you back for another week of making sense of money and the markets. And this week we're going to start by focusing on money because our guest is Sam Dogen, who is the proprietor of financialsamurai.com. Like me, Sam actually started his career on Wall Street. He worked for Goldman Sachs as an investment banker. And spent 13 years in that industry before leaving to then start the Financial Samurai website. Before that, he got a BA in economics from the College of William and Mary. He got his MBA from Berkeley. So after leaving Wall Street, Sam started his Financial Samurai website, where he both writes about and personally lives the lifestyle habits for those who want to achieve financial independence, which is a combination of being both money smart, but also reducing your material needs and wants. Sam's advice is applicable to anybody watching today's video, regardless of your current income or net worth, which is why I'm super excited to pick his brain today. Sam, thanks so much for joining the program.
Thanks, Adam, for having me.
Hey, it's a real pleasure, and I'm very excited to get into this topic. We've been talking about the markets for so long. I wanted to switch to the personal finance side, and you're a great guest to do that with. So, all right, as I said in the intro, you've created Financial Samurai to help people find the path to financial freedom. And I believe this all started with you, following the rules that society encouraged you to follow. Go to great college, get a high-paying job, save and invest. And yet you found yourself at one point kind of losing the game, even though you were quote unquote doing everything right. Why is financial independence such an elusive goal for so many people?
I think it's just our human nature that we always tend to want more. One of the things that happened to me was that I blew myself up in 2008 and 2009 because of the financial crisis. I had aggressively saved 50+% of my after-tax income every year. I diversified away from equities into real estate. I thought I was doing the right thing, but then of course the financial crisis came and I lost about 35% of my net worth in about 6 months. So that was really a wake-up call for me to think about maybe doing something new, because at that point, anybody who worked in the financial services industry was like a bad guy. Didn't matter whether you had nothing to do with the housing bubble or the mortgage shenanigans, you were just a bad guy. And so for me, I thought, well, I wanted to do something new. And so that's actually when I started Financial Samurai in July 2009. I'd been thinking about it post business school in 2006, where I went part-time, but I just delayed it because I had other things to do. But to answer your question specifically, achieving financial freedom is difficult because there are so many landmines that can happen when you take investment risk. March 2020 was a perfect example. You lost 32% of your stock portfolio from peak to trough in about a month. So there's always risks to be had, and there's also your own demons of battling how much you need to be happy, how much you want to live the desired lifestyle.
All right, so I'm just curious because I know you hear from people, day in and day out on this. Like, what are the biggest obstacles and maybe self-sabotaging behaviors that get in people's way of being able to build capital and grow their net worth?
Well, I think there are so many self-sabotaging things, especially if you're working in a highly competitive industry. You see your peers getting paid and promoted, they're buying the bigger house, more cars, they're going on vacations, and you just tend to want more of that. And so whenever you get satisfied, I mean, there's a whole saying, when do you know when you're rich? It's when you make 3 times more than you currently are making now, or have 3 times more than you currently have. The biggest self-sabotage is not knowing how much is enough, and looking at someone else's lifestyle and thinking that's what you need. That's my main thing right now, because I'm here in San Francisco. There's tons of type A personalities who are just go go go. Someone's started a company and their company went public and they had a $5 million windfall, maybe 10 million, maybe 50 million, who knows? It's like a never ending battle. And I'm trying to actually get out of this go 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 mentality and go back to Hawaii and leave some of these go 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 people behind, and to make their fortune, which never seems like enough.
Yeah, that sounds quite nice. There's a quote that we've been bringing up on this program recently. I'm going to paraphrase it because I can't remember it exactly, but it's by JP Morgan, and it's something like, nothing undercuts people's rational thinking more than watching your neighbor get rich.
Yeah, for sure.
Yeah, and especially in today's environment where there's it's so hard to get a good return playing it safe, right? In the old days, you could put your money in a cash savings account, or you could put it in treasury bills or blue chip bonds, right, and get enough yield to be worth something. Now you can't. Mm-hmm. So people see their neighbors getting rich in these, speculative stocks. They feel like they have to speculate even more to try to keep up with them, right? So it just pushes everybody way onto the crazy risk curve. So, there's definitely the self-destructive kind of keeping up with the Joneses behavior. I assume as well, I'll mention a quote by Thoreau that I like to toss out there, but there's sort of a lifestyle management part of this, right? The Thoreau quote I really like says, "Make yourself rich by making your wants few." So I presume part of this, I think you were saying this earlier, is just defining what wealth is for yourself beyond just money, and maybe finding ways to get a lot of fulfillment out of life that isn't dependent upon, aggressively growing your income streams or your savings. Is that true?
Sure. I mean, absolutely. When I left in 2012, I had about $80,000 in passive income, from real estate, dividend stocks, and so forth. And I thought that was enough to be happy. My wife, who is 3 years younger than me, she left 3 years later. And so we were like, well, okay, well, why don't we just double that to about $150,000 in investment passive income? And then we're, living a good life. And then in 2017, we had our first child. And then we thought, well, we should probably up that passive income figure to 200,000 because, tuition, healthcare costs, we pay over 2,000 a month in healthcare premiums. We got to plan for the future. And then we had another child in 2019, and we feel very blessed. Then we said, well, we probably should shoot for equality and shoot for another $50,000 in passive investment income. And it just keeps on going. But I think we're done now. And so, yeah, it's also a challenge. It's a game that I like to play to try to make money in a risk appropriate manner. When you're talking about, always having to take more and more risk, eventually you're going to blow yourself up if you take on too much margin debt or mortgage debt or so forth, and the market goes sideways. The key is really to survive this game and earn a very stable, I think, IRR over as long of a period of time as possible. Because once you get a really nice sizable capital base, the number one rule in my mind of financial independence is to not lose money, to not go backwards. So, once you've tasted that sweet nectar of freedom, you don't want to go backwards and be someone's employee or have to do something for money again.
All right. Well, let's talk about the success factors for doing that. And as you explain them, if you could just define IRR, because you and I know that from our days on Wall Street, but I'm not sure every person watching this video understands what internal rate of return is. And maybe we could start, Sam, with you sort of summarizing the tenets that you talk about on your website for what are the critical success factors for becoming financially free. You talk about passive income. I think for a lot of folks, that's a wonderful concept. They don't necessarily know how to generate it. So if that is indeed a critical component, maybe you could tell people, what are some of the options that you advise people consider?
Well, I have a couple principles that I like to tell everybody who asks. And that is, The first one is if the amount of money you're saving each month doesn't hurt, you're not saving enough. So if anybody has ever had braces, your teeth aren't moving or getting fixed if there's no pain in your gums. So if the amount of money you're saving each month doesn't hurt, you're not saving enough. That means you're simply just going through life, spending most of your money and not really being cognizant of savings. It has to hurt a little bit to force you to make some spending changes and investment changes. The other principle I have is to never fail due to a lack of effort, because effort requires no skill. If you look at some successful people, wealthy people, you might envy them for their wealth or for their smarts or their good looks or whatever. Not all of us are the same, but the one thing we can control is our effort. And so if you try hard enough for a long enough period of time, I think we're all going to surprise ourselves that good things are going to happen. You just have to stay in the game for a long enough time and something good will happen. You just don't know exactly what will happen, but something, I promise you, something will happen. So those are the two kind of foundations for financial independence and having a goal of what your lifestyle should be. It's really easy to do a lot of back of the envelope calculations and say, hey, I'm happy living off $50,000 a year, for example, or let's say it's $100,000 a year. So what type of capital or how much capital do I need at a 4% rate of return withdrawal rate to get there? And that's 2.5 million. But unfortunately, interest rates have come way down since the global pandemic. The amount of capital you need is much greater. And this 4% rule that people talk about, that was popularized by the Trinity study in the 1990s when the 10-year bond yield was at 5%. It's a different game now. Of course, you could withdraw at a 4% rate of return when the risk-free rate of return was 5% in 1997. Right now, the 10-year bond yield, it has come up, but it's at 1.5% now. So everything is intertwined with the risk-free rate of return. And so you've got to really think carefully about your net worth target to achieve financial freedom and your withdrawal rate to sustain your financial freedom.
All right. So obviously it sounds like doing the math really important here. Sit down, maybe create a spreadsheet, do some projections, get a really clear sense of, what you need to save up to meet your needs and what's a sustainable withdrawal rate given the realities of the world today. And very interesting to point out that reality does shift. You just mentioned that the 10-year rate, went from 5% to 1.5%, and actually it's come up to 1.5%. So it was much lower over the past year. So and we've talked in past programs about the challenges to savers in this extraordinarily, historically low interest rate environment. I might want to get into that with you in a bit if we've got time for it. But I presume along with just doing the math too, there's also got to be a strong sense of, look, what do I really need, right? I mean, everybody would love to be taking, champagne baths and, trips to Monaco. But I imagine a big part of it is to say, look, what are the things that really give me fulfillment in life? And how can I focus on, securing the ones I care about most? And maybe even, asking myself, look, if I value, the ability to travel, that's great. But maybe I travel to a nearby lake for a weekend on the lake, as opposed to traveling to Hawaii or Europe. And you're still getting the travel experience, but you're not just hemorrhaging money. So is that sort of, goal rationalization a big part of it too?
Sure, why not? The secret to financial independence is to have enough semi-passive to passive income to cover your desired living expenses, right? So it's all about starting small. Maybe, your first investment, you want to generate enough passive income to cover your monthly water bill, and then try enough passive income to cover your monthly food bill, and then your property taxes. Maybe you have a mortgage, maybe you don't. And then your travel expenses, transportation expenses, child's education expenses, healthcare expenses, and so forth. So instead of just saying, I want to have $100,000 in passive income a year, I would chop that up and say, I want to generate enough passive income to cover my healthcare insurance when I'm retired. And so when you take those specific steps, it becomes much more manageable, because getting, you know, from 0 to 100,000 passive income, or 200, 300,000, is very daunting, and people won't know where to start. So focus on specific needs that your passive income can cover, and then go from there. And then once you got all your needs covered, food, clothing, shelter, transportation, healthcare, then you can move on to your wants, your vacations to Hawaii, beachfront property, flying private, whatever you want.
That's, I think, a great way to look at it. You come up with a bunch of targets that are on the essentials list, and just start going after them one at a time. Start small, work bigger as you go up. Only once you've got all those, then head on to the wants part of the equation. All right, Sam. So you've mentioned passive income a number of times now. Can you just talk a bit about really how one goes about acquiring passive income? I think for a lot of people who are watching this, their investing experience really is probably mostly, I buy a stock and hope it goes up. So it's a bit of a different mindset when you're investing for income. So can you kind of help sort of demystify that space for people, and maybe give some recommendations of some areas that, sort of newbies to the process should look at?
Yeah, so you got to think about whether you want to build your capital or you want to build income. You can obviously do both. But for people who are under 30 years old, maybe under 40 years old, in my mind, I think you should invest in growth stocks or growth investments that actually don't pay a lot of income. Your goal when you're younger is to try to build up your capital base quicker, so that once you have that chunky amount of capital, then you can produce some of that income when you're older, more tired, don't want to work as much, and have more to lose. And if you think about building capital versus generating income, put yourself as the CEO of a company. For example, let's say Tesla. Tesla is not going to pay out a dividend because the CEO wants to reinvest its cash flow or retained earnings into growing the business, because the growth of the business will be much greater than paying out an interest or a dividend. So when you're younger, I think you should invest in growth stocks, maybe private equity, maybe a lot of the things that actually have a lot more risk, but actually have a lot more potential returns, because you can make up for those losses when you're still young. Once you get older, or when you see yourself, let's say you have got to forecast the future in 5-10 years, you don't want to work as much, or you want to get out, then you've got to start thinking about transitioning into more passive income sources. And I have a ranking system on Financial Samurai where I rank several passive income sources by risk, return, feasibility, liquidity, activity, and taxes. And so from the worst to the best, I have P2P lending, private equity, CD money markets because they hardly pay anything, real estate, creating your own products, fixed income bonds, real estate, crowdfunding, and dividend investing. But you know what? Times are changing a little bit given interest rates are so low. You've got to go through every single type of passive income source, analyze the risk, the return based on your risk profile, the feasibility of investing in such instruments, right? Not everybody can invest in private equity funds, for example. Your liquidity needs, how much you have to spend generating this income, and also the tax consequences.
Okay, great. So that ranking system of these different passive income streams is on financialsamurai.com. If someone just goes to the site and types in passive income, is that the best way to find it?
Yeah, you can just Google ranking the best passive income investments, and you'll find a chart that I put together with those variables and those various passive income sources. And I go through every single one and share why I think it's ranked where it is. And it's all up to someone's own risk tolerance and goals. And again, also your income stream as well. You might have active income or consulting income or supplemental retirement income. If you're in a high tax bracket, for example, one of these passive income sources might not be as good as the other.
Yeah, and As we do every week, once we say goodbye to you on this program, Sam, we're going to bring on the lead partners from New Harbor Financial, and it's their whole reason for being is helping people make decisions like this, taking into account their entire individual, unique, personal financial situation. So, just to underscore your point there, yes, you want to see all the different options that are out there, but then you want to pick the ones that are most appropriate for you, given your goals, your financial situation, your risk tolerance, all that type of stuff.
Personally, I'm more bullish on real estate as a passive income source right now. As we know, the 10-year bond yield has gone from 0.51% to 1.5% today. It's from August 2020 to now. However, rates are still low. I think there's a huge demographic boom happening with the millennial generation prime into home buying years. I think rates are going to be low for the rest of our lives, frankly. I don't think the 10-year bond yield is going to go over 2%, 2.5%, which is going to make real estate affordable. I think there's positive demographic trends post-pandemic where people are flooding to lower cost areas of the country, thanks to technology and work from home. And given rates have come down, it takes a lot more capital to generate the same amount of risk-adjusted income. However, if you look at rental properties, they have not increased in value as much as the increase in value of the rental income. And so I think there's a tremendous opportunity to build passive income through rental properties, real estate crowdfunding, single family homes. And I think this is going to be a multi-decade trend. And I think it's just a much more stable way to generate passive income. You can invest in your growth stocks, and instead of investing in bonds or in dividend stocks, I think you can couple that with real estate. And that kind of 1-2 punch, I think, is really attractive for a lot of investors, including myself.
Great. I'm really glad you underscored that, because we have talked about the value proposition of investing in real estate for a while now. For folks watching this, if you haven't seen the interview we did about a month ago with Victor Minash on real estate investing, we'll put up a little notice of that here, and you can look at that online. But I want to dig into one thing that you mentioned there, which was the real estate crowdfunding. So, people are familiar with investing in real estate by buying a property and managing it as a landlord. And I know you've done that, Sam. I think you've gotten out of that game. Talking to Victor, we talked about doing larger projects, and as an individual, perhaps not funding those large projects yourself, but joining as an investor as part of a real estate syndicate. So that is one option. But then there are these crowdfunding options you're talking about, which are kind of like syndicates, but you can put a lot less money into some of these things.
Right.
Explain them for us if you could.
Yeah, so real estate crowdfunding is private real estate syndication deals where the platform vets sponsors who bring these deals to market, who sponsor these deals. And the platform also vets these deals as well. And the platform puts online all the data about the deal so you can make an informed decision. And it's a way for these sponsors to raise capital. And it's a way for retail investors and accredited investors to more efficiently find deals that they might be interested in. And obviously, every single deal is different. The idea is for the platform to bring on board the best deals that they review. And then it's up to you to review the best of the best and make a decision accordingly. Now, I think real estate crowdfunding is a really great idea because it allows retail investors to be able to diversify their assets across the country. For example, I live in San Francisco. I am heavy single family home properties in San Francisco. And I do still have rental properties. This is all from 2005 and later. And so I realized earlier, years ago, but finally in 2016, that I should probably diversify some of my real estate holdings, not to just expensive San Francisco, but maybe to Memphis, maybe to Austin, maybe to Charleston, where cap rates are much higher, net rental yields are much higher, demographic trends could be much faster. There's no monopoly on Silicon Valley. Well, maybe there is, but I don't think so. And so I wanted to identify the next Silicon Valley. And so I started investing in multiple properties through a fund that way. And so I like it that way because it's a way to invest in real estate without having to manage real estate. Because I don't want to deal with too many tenants or maintenance issues. And at the same time, I want to invest in real estate, have a more stable asset class, and earn income 100% passively.
So that all sounds great, and I'm sure it sounds appealing to a lot of folks that are watching this. If they want to learn more, this isn't an endorsement, but are there some sites that you'd recommend people go check out?
Well, so I've spent hours and hours creating a real estate crowdfunding learning center. So if you just go on financialsamurai.com, and one of the top menus is invest in real estate. So I've put together all the articles that I've written and I've done research on the benefits, the pitfalls, taxes, everything you can think about. I put it there so people can make a more informed decision.
All right, awesome. So if you're listening to this and that's of interest to you, go to Financial Samurai, look for that up in the navigation there. Thanks for putting that sort of summarized resource there for folks there, Sam. All right, well, look, in our last couple of minutes here, Sam, I want to hit you with a couple of questions. Give me the quick synopsis. Don't feel free to go. Don't feel like you have to expound with a diatribe here, just because we don't have a ton of time left. But these are big questions. So
big questions, short answers. All right.
Yeah, we talked earlier about the challenges that investors face right now because they're low interest rates aren't giving them good yields. Yeah. One of the flip sides is that the exact same intervention that's leading to these low yields is driving up the cost of living, right? And so the cost of living is increasing dramatically for many people. Wages are not keeping up. They're not getting safe returns in the marketplace. So how threatening is this to the financial freedom movement? The sense that expenses may be growing a lot faster than capital appreciation.
Well, that is the key thing that people need to be aware of. Medical expenses and tuition expenses. If you retired early and you have kids, you want to pay for college or private grade school. Those are the two expenses that are growing at around 6 to 7, maybe 8% annually, compounded, versus CPI of 2% maybe. And so because of these core expenses that are growing so quickly, you might have, well, the good thing is that if you're an investor and you have enough passive income, hopefully the earnings growth from your stocks and your real estate will grow at or faster than the rate of inflation. But you have to also just be aware of those two core expenses because look, once you have your property paid off, or you own your property, you have a 30-year or a 10-year or 15-year fixed rate mortgage, life is not that crazy expensive once you have your living expenses paid off, right? So if you have a great passive income portfolio, you've got your living expenses handled, you have to keep an eye on the medical costs and the tuition expenses. That's it. So if you feel like your passive income portfolio is not covering that or not keeping up, then maybe you need to earn some supplemental retirement income.
Okay. All right. Next question is, since we're saving, we're investing, every week on this program we have a market expert come on and prognosticate on what they see coming forward. And I will say that the vast consensus amongst the folks that we've had on over the past years that these markets are not just richly valued, but at unprecedented levels of overvaluation. And many of them have said, look, they think the odds of a really gut-wrenching market correction, 50+%, is unreasonably high at this point in time. And so let's presume for a moment that they and other big luminaries like Jeremy Grantham and other folks who have been investing for decades and decades and decades believe is going to happens. How much of a risk does that pose here to the folks that you're talking to on a daily basis? If there was a 50% market correction this year?
Well, first of all, I don't think there's going to be a 50% market correction. I think Jeremy Grantham has been a perma bear for decades, and he's a very wealthy man, even though he's a perma bear and runs mostly long equity funds. But if there is a 50% correction, let's peg that at a 10% chance in 2021. I think it's going to be short-term pain, and anybody who has been properly diversified and who has 5 to 10% of their investable assets or net worth in cash, like I've been discussing for a while now, is going to be fine, because we're going to utilize and follow our system to take advantage and invest in investments that are actually going to generate higher yields, because the principal value is down 50%. It actually could be a wonderful time to jumpstart your passive income portfolio even more. The thing is, let's see what happens. If equities, let's say, go down 50%, will the dividend payout ratio get cut by 50%? And maybe, maybe not. I don't think so, not by as much. So actually, on a relative basis, if you start thinking about income as a way to survive, because if you're retired, if you truly are retired, you care more about income versus your capital. I think it's going to be fine. It's going to be a really painful, scary time and probably depressing, but we have contingency plans for that. We have our cash and we're focused on income. And that's another reason why I like real estate, because yes, 10% chance we could see a 50% correction in S&P 500, but is there a chance that there's going to be a 50% correction in the median home price of 340,000 in America down to 170,000? No way. There's no way. I mean, it might happen, but it would probably have to take 10 years or maybe 20 years. And if that's the case, then we're going to be in a structural deflation environment, and things are going to be really, really bad. So in this type of scenario, you just have to think, okay, yes, your equities get crushed, but probably your bond portfolio is going to do really well again, as risk money goes to risk-free money or lower risk money. And your real estate portfolio is probably going to do pretty well, or relatively well, because rates are going to go down and money goes to more stable asset class like real estate. So be diversified, think through scenarios. I don't think that worse is going to happen. And just always keep the faith.
All right, good answer to a tough question. Two last questions here. One, we've talked about this a bit, definitely in our last video, so I won't go into the weeds of it with you, but I'm just curious to get your opinion. Right now, again, in such a low interest rate environment, there is a huge difference between those people that are receiving a pension and those people that aren't. Right, if you're receiving a pension that is $50,000, $100,000, that's like having tens of millions of dollars in the bank at today's interest rates. And so, those people who worked in the private sector don't have the benefit of a pension. They're at a real disadvantage. Could you almost say, and I'm saying this a bit tongue in cheek, but like, hey, if you really care about passive income, go get a job with a pension.
Yeah, I mean, I think people in the public sector who have pensions really have won the lottery in a declining interest rate environment. $100,000 is not worth tens of millions of dollars. Let's say at a 2% withdrawal rate or risk-free rate or whatever, it's worth maybe $5 million, but still it's millions of dollars. And if it's for life, then you better get in shape and try to live as long as possible and stop messing around. Unfortunately, I think every industry that offers pensions is making it harder to get a good pension. So you've got to work longer, and your pension payout is getting cut. So yeah, go get a pension, but it's going to take you 25 to 30 years to get that pension. So it runs in direct, conflict with people who want to retire early. So it depends on where you are. If you're listening to this video interview when you're in your teenage years, or maybe you're 20 or in college or under 25, yeah, I would try to go get a pension. 20, 25 years of doing the same thing, you might bore yourself to death, but by the time you're 50, you could be set for life, and then you can actually get another job and double dip. But for those of us who are in our 30s, probably anybody over 30, I think it's too late. You spent 10 years. The last thing you want to do is spend another 25, 30 years to try to get a darn pension. You'll be 60 years old and your life will be more than half over. So forget it.
Okay, great. All right, last question, which is, I'm sure a lot of viewers here are probably, like most people, where maybe they've been inspired by what you've been saying, but they reflect on their personal situation and say, boy, I'd like to be more successful than I've been yet today in, growing my net worth, getting closer to the retirement that I want to have, or at least the financial independence I want to have. What would just sort of be your parting high-level advice to those folks?
Never fail due to a lack of effort, because effort requires no skill. That's the money mindset you should have. You deserve to be rich. There are CEOs out there with multi-million-dollar severance packages that drive their companies to the ground. Okay. There's so much money out there. You've got to believe in yourself that you too deserve to be rich. This money mindset, like once you have that positive money mindset, you'll be amazed at how many more opportunities come at you. Yes, do the math, do your research, know what's out there, know your risk parameters. But as soon as you start believing you deserve to be rich, I think a lot of good things will come. And it's not just, hokey pokey mumbo jumbo. Just look at the amount of wealth that people are creating for themselves. And when you start asking yourself, wait a minute, why are they getting millions or tens of millions of dollars when, they were my dummy classmate back in school, or, what did they do that's so special? As soon as you change that mindset to say, hey, you deserve to be rich too, I think good things are going to happen.
Great point. Develop the right success mindset for this. One anecdote to your point there, because you and I think went to similar schools, worked in similar places in Wall Street. There actually is this term that classmates of ours who are now in that industry use called the money river. And their whole game is to get their firm, to get as much of that money river as they can. And it's shocking, and hell, it may even be immoral. But it doesn't mean it doesn't exist and it's not out there. And to your point, once you ask yourself that question, well, why should those guys get all of it? Why can't I siphon some of that my way for more productive use? That does begin to open doors in your mind of, okay, what are things I can do to actually begin to start tapping into that in one way, shape, or form? All right, Sam, well, look, in wrapping up here, thanks so much for sharing so much of your time with us. Great insights. If folks are interested, inspired by you, want to learn more about you,
they should just go to financialsamurai.com. You can leave a comment, and I read pretty much all the comments. You can subscribe to my newsletter, financialsamurai.com/newsletter. And I'm always around. I've been around since 2009. There's nothing more I like to do more with my intellectual free time than to write and to pontificate and to put those pontifications into action, because this is real life, folks. There's only one shot at it, so you might as well make as much money as possible and in as a comfortable way as possible, and live the life that you truly want.
All right. Well, super well said, Sam. Look forward to having you on this program again at some point in the future. Thanks so much for your time, and I'll let you go, and we'll follow up here with John and Mike from New Harbor. But thanks so much, Sam.
Thanks, guys. Take care.
So John and Mike, it's so interesting. We've had so many guests here that I feel like everybody sort of brings a piece to the puzzle. And it's always really validating for me when, a guest looks at this, landscape from a different perspective and yet still comes to similar conclusions, either as I do, or you guys do, or some of our past guest experts do as well. And, what I heard from Sam was, hey, look, there is a lot of risk out in this market. And so, you've got to be smart in terms of identifying the right opportunities for you, given A, your personal financial situation, but B, the risk and realities that are on the ground. He talked about, in this type of market environment, A, being diversified, but B, keeping a healthy cash balance in case there is a market correction. We talked about the importance of real assets, of income producing assets. A lot of these things that I've heard you guys at New Harbor talk about, year after year after year. So just curious, John, we'll start with you. What's your reaction to what Sam said there?
Yeah, no, I think he had a lot of really good insights of practicality and frugality and smartness as it relates to one's financial security and positioning. We always like to ground the statements we make in data and perspective. And if I could be fair, I think a couple of observations there need to be kind of called out a little bit. Like, for example, the comment that Jeremy Grantham's a perma bear, it's just not true. In fact, if you go back to do a web search for Grantham bubble melt up. And in January 2018, he was calling for a 50-60% melt up in the stock market. So that doesn't sound like a perma bear to me, nor did his call for the market to kind of start going up in March of 09, literally right near the bottom. That doesn't sound like a perma bear. So I guess we are often very careful, or need to be careful about being very grounded in what we say, and rather than these broad brush things, and like a 50% correction with a 10% probability. Well, that's a possibility, I guess, but the data actually suggests it's quite greater than that in terms of probability. So, but no, a lot of his comments, I think real estate comments were right on. Even his life story about, choosing a different path, being dissatisfied with the financial industry career he was on. That's great, admirable stuff. I think everybody should take time out to think about their life path and not be confined by their own, current circumstances, and certainly not their mindset. That's a great lesson for everybody.
Yeah, well, two things. So one of the things he said was, really work on saving, right? Like you're not saving enough unless it's hurting, right? And I agree with that. And there's a saying, I can't remember who popularized itself or popularized this in the personal finance world, but it's called pay yourself first, which is, every month we've got to pay expenses, we've got to make investments, et cetera. This person said, look, the first check that you should be writing is to yourself, meaning, hit your savings goal and then get really creative if you have to about how you're going to meet those remaining expenses. But it's just way too easy to do the opposite, to say, oh, I've got all these bills, I can't pay myself this month. And then, months, years go by and you haven't been investing in your future. You've just been basically, feeding all your creditors. So, and that may, getting creative might mean actually, having to do without some of these services. Maybe that's a signal that says maybe you've got, too many expenses in your life, given your goals, right? So I definitely agree with really strengthening that savings muscle, which, you've heard me say many times, but the Federal Reserve and its low rates has really kind of crushed people's incentive to save. But that doesn't mean it's still not extremely important. When Chris and I talk about building resilience, we talk about a lot of different steps that individually and by themselves are not going to bring, they're not going to solve the situation for you, but they're essential. So, we call them, they may be insufficient, but they're necessary, right? And saving in today's environment is a classic example of that. Is you got to do it. It's maybe not the whole game for you, but you're not going to win it if you're not saving hard. And Mike, I'll let you answer this, but you guys are in the business of helping people chart their financial futures. And I've got to imagine it's quite common for people to come to you and say, okay, here's my situation, and really I'm not as far along as I'd like to be. So guys, how can you help me go from point A to point B, where point B is the kind of future I want to have? I'm probably just stating the obvious here, but is that a pretty common interaction? And if so, are there pearls of wisdom that you can pull from Sam that match well with people's needs when they plug in with you?
Yeah, Adam, thanks for that. Yeah, people are always worried about having enough. It's one of life's big fears, I guess. I like what Sam said about attitude. There's having a positive attitude can go a long way. Sometimes just working a couple extra years makes a huge difference. In fact, it always makes a huge difference in the mathematics of it. If you simply work a few more years versus retiring early, it shifts the probabilities much more in your favor, having enough income. So, yeah, it's never too late, obviously, and you don't necessarily need as much as you think. I know that a lot of financial press tries to scare people saying they need many millions of dollars. And part of that is true if you're going to park your money completely in a safe investment like a certificate of deposit at the bank. Like you mentioned earlier, you need a huge amount of capital just to spin off enough income at a risk-free rate of 0.1% or whatever the local CDs are offering. We believe that the stock market is very late stage in a bubble, and we think that you can outperform even with more modest means by reducing risk here and then taking more risk at lower prices. I like what Sam talked about with crowdfunding and real estate and syndications. I think it's a lot harder to get hurt if you put your money into that or put some money into that, but we think there's still a place for traditional financial assets, stocks and bonds, just not really at these levels. And we remain at the highest valuation levels in US history, with expected returns over the next decade solidly in the negative over the next 10 years or 12 years, probably -4, -5% a year is what can be expected from here. We cannot time the drop. We cannot predict how far we go down, though a 50% drop is quite likely, maybe not this year, but over the next couple of years, based on where we're at. Who knows? Maybe the central banks will be successful in keeping us at a permanently high plateau. We don't think so. And what we're doing managing money is to have very minimal equity risk. We have only about 8 or 10% net equity risk, and still a pretty heavy cash cushion to take advantage of opportunities.
Okay, great. Well, look, let's in the remaining few minutes we have, let's just talk about what's happened in the markets since last week, because we've had this long string of the markets really not doing much of great interest. They've just sort of been hanging out at their historic all-time highs, and we've seen a lot of price inflation in a lot of different areas like Bitcoin and whatnot, which last week we were talking about how it blew through $50,000 a coin. What's been interesting about this past week is we're all of a sudden beginning to see the market wake up to these higher interest rates, right? To the fact that the 10 years now at 1.5. We were flagging that in the past 2 weeks on this program, but it seems like the market all of a sudden began to get the jitters about it. And so we've seen the indices look weak this week, and then today we had the first really big down day in a long time. We've also seen Bitcoin pull back a bit. I'm not sure where it is the second that we're talking about it, but it went from a high of about 58,000 or so, and it got as low as 45 or 46 in the past 24 hours. I think it's maybe back up around 48, 49 right now. But we're seeing a lot of volatility, and certainly the kind of parabolic rise of Bitcoin seems to have been stunted here. Precious metals look a little bit weak, and you would expect that if it was coming on concerns of higher interest rates, because that takes a little bit away from the value proposition that the precious metals promise, because they don't offer any direct income yield themselves. But anyways, what else has caught your guys' interest this week? What are you looking at? John, why don't we hand it to you?
Adam, definitely the story of the last week is interest rates, and I think that one point is huge, because it is a event that certainly isn't a welcome event for Federal Reserve monetary policy. It's not a welcome event for anybody in this kind of debt financed market or world even. It's actually quite a concern, and you're starting to see that. Just as you said, 10-year Treasury bonds yields they closed at 1.5%. They spiked up actually midday today to like a little over 1.6. I'm not even sure what happened there, but it looked like something broke. And honestly, I wonder if my quote monitor is broken, because it was and I think we had the worst. When the Treasury issues new bonds, they do so through auctions. I think the 7-year Treasury bond auction today was the worst showing ever, I think, if I saw some news headlines correctly. So there's definitely some breakage going on here. And the Fed has been out, Fed policy heads, talking heads have been out trying to assuage fears about, the rise in interest rates, because that is ultimately the thing that may force the Fed to come off, the easy money policies that have really been the fabric of the world for the last decade. Because that does really create a real big problem for them. And yeah, of course, things like stocks, which are, have always been said to, over the last decade anyways, to be, well, with interest rates this low, stocks are attractive. The yield on the S&P 500 is right on par with where 10-year yields are right now. So stocks is a better investment than 10-year bonds. Just simply on a year basis is no longer a case that can be made. But of course, precious metals haven't liked that in the move in interest rates. But here we still stand with the stock market only about 2.5% off its all-time highs on the S&P 500 anyway. So, we haven't seen anything yet. Now, we do think the yields probably have moved up too far, too quick, even if they're longer term going to go higher. And in fact, we did, for some of our larger client accounts that would enable a certain position size that we were looking. We did actually do a little toe dipping into some long-term treasury bonds through a covered call option investment on an underlying ETF, meant to be a short-term tactical trade that we think will, likely benefit by a near-term retreat in yields, if not, even if the longer-term trend is higher. So those are some of the notable things I'd like to call out.
All right. Well, good summary. Interesting to hear about that short-term long treasury trade. Be interesting to see what happens there. But we'll be tracking these interest rates very closely, folks, over the next couple of weeks. As John said, this is the one thing that the Fed is afraid of, and this is the one thing that really is kryptonite for the market mania that we've had is higher interest rates, particularly them being market-driven, not being Fed-driven. Things maybe are starting to get interesting. I don't know. But like I said, whatever happens, we'll be tracking them here on a week-to-week basis. We've had lots of our past recent guests have been folks that are focused on the markets. As I said at the beginning of this program, I wanted to start bringing in some experts that were more focused on the personal finance side, on how to actually make money, how to actually manage your personal finances, et cetera. If you like this type of content and would like to see more of it, please just let us know in the comments section below. And with that, guys, we'll wrap up this week. Very quickly for folks watching, if you haven't yet, please take a second and just hit subscribe on this video. It's right down there under the like button, and click the little bell icon as well. That way you'll get alerted when new videos like this get promoted. Secondly, while you're down there, click the like button. That actually does make a difference in how well these videos are picked up across the internet. Third, if you want to know who is going to appear on this program in coming weeks, and if you'd like to actually suggest guests that you'd like to see on the program, please follow me at Menlo Bear. That's me on Twitter. I do make those early announcements there, and I do listen to your suggestions. And last, if you've been inspired by what Sam had to say, or you're increasingly concerned about the markets and the way in which John and Mike have been talking about, if you're unaware of it and haven't yet done so, the folks at New Harbor, as a public service to the Peak Prosperity audience, they offer a free consultation where you can talk with them, you can share the details of your personal financial situation, and they will give you their best advice on what they think you should do. It doesn't cost anything. There's no obligation to work with them. If that's of interest, stick around to the end of this video. We'll tell you how to sign up for that. It takes just a couple of seconds. And with that, we'll bring this to a close. John and Mike, thanks for being on this week. Like I said, things might be getting interesting. I'm really kind of interested to see what's happened by the time we meet next week. But whatever has happened, we'll cover it here together. And thanks so much again, and we'll see you next week.
Thank you, Adam. We'll see you next week. Nice to be here. Thanks.
Good to see you again, Adam. We'll see you next week. Thanks.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right. With all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.